Well, hello everyone, and thank you for attending the event and coming to learn about the wonderful world of Fatca. So we have a lot of stuff to cover, so I'll just give you a brief overview. First, we're going to talk about the history of Fatca, what it is, why did it come about, and give some key definitions, because like any other U.S. tax law, this thing is heavy on definitions. Then we're going to talk about what are the obligations for you as Brazilians as a withholding agent under the Fatca law. We'll discuss a little bit about the myriad types of forms that Fatca requires. We'll go into detail about the intergovernmental agreement between the U.S. and Brazil. And then finally, we'll conclude with some remarks about how this law impacts both U.S. people and Brazilians. So first, why did Fatca come about? Well, first of all, Fatca stands for Foreign Account Tax Compliance Act. And what the U.S. Congress was worried about were U.S. people going to Europe, going to offshore jurisdictions, and hiding their money. You may remember back in the mid-2000s, the U.S. Department of Justice started bringing actions against UBS in Switzerland because the Department of Justice was alleging that Swiss bankers were helping United States taxpayers hide their assets and not report those things to the IRS. So Congress enacted this law in 2010 and this is its stated purpose, to clamp down on tax evasion and improve taxpayer compliance by giving the IRS new administrative tools to detect, deter, and discourage tax abuses. So Fatca actually was a two-step process. The first process was a new requirement that U.S. taxpayers voluntarily disclose their financial accounts offshore. Now, just in case not every U.S. taxpayer decided to do the right thing and volunteer this information, Fatca implemented the second step, which was to require foreign financial institutions to report and record information about their U.S. account holders. These would be compliant institutions under Fatca. If a U.S. investor, a U.S. person decided to put their money in a non-compliant institution, then there would be a 30% withholding tax on certain U.S. source income payments to those non-compliant jurisdictions. So the whole purpose behind Fatca is to report information about U.S. taxpayers. And they kind of give this deterrence of a withholding tax if U.S. taxpayers don't use compliant foreign institutions. Now, generally, the withholding rules came into effect as of July 1st of 2014. There are numerous exceptions and numerous transition rules, but generally, withholding began as of last year. Now, the IRS is aware that Fatca is complicated. There may be some troubles following and implementing it. So for 2015, they've considered this a transition year. So they aren't going to impose harsh penalties on institutions as long as they made a good faith effort to comply with Fatca. Now, the IRS hasn't really defined what good faith efforts are, but I'm sure they'll know it when they see it. So the general rule under Fatca is that any withholding agent that makes a withholdable payment to either a foreign financial institution or a non-financial foreign entity must either obtain valid documentation as to that institution's Fatca status, or also called Chapter 4 status, and then verify that institution's Global Intermediary Information Number, a GIN, G-I-I-N, and if they can't do that, then they have to withhold 30% of the withholdable payment as a tax to the IRS. Now, we'll go into these terms a little more in depth, but that's the general rule. Now, it's important to note that if you make a payment directly to a U.S. person, you don't have to worry about Fatca. Also, payments directly to foreign individuals aren't subject to Fatca. However, if you make those payments to that person's bank in a foreign jurisdiction or to their offshore holding company, that's when Fatca is going to apply. So who is a withholding agent? Well, that's any person, U.S. or foreign, in whatever capacity, that has control, receipt, custody, or payment of a withholdable payment. Now, under this definition is pretty broad, so multiple people can be considered a withholding agent for the same transaction. So, for example, let's say I'm going to use J.K. Rowling's Harry Potter character in the United States, and I'll have to pay her a royalty. Well, that's a U.S. source payment, that royalty. So I'm a withholding agent there because I've got control of the royalty. If my bank, Bank of America, is going to make the wire transfer, they're a withholding agent. Let's say, I don't know if Ms. Rowling uses this particular bank, let's say she uses Barclays in Britain. If I make the wire transfer, if Bank of America makes that wire transfer to Barclays, Barclays then becomes a withholding agent too. So you can see multiple people down this chain can be withholding agents. And as I said, it's broad. It's not just U.S. people, it's also foreign persons as well. So that's why it's important for everyone to know the rules applicable to withholding agents. So under the Fatca regime, all foreign entities fall within two categories. They're either foreign financial institutions, FFIs, or non-financial foreign entities. And why is this distinction important? Well, there are more burdensome requirements on a financial institution than there are on the non-financial foreign entity. There are different rules that apply depending on what kind of entity you are. So you have to know where you fall so that way you know what you have to do to comply with Fatca. So what is a foreign financial institution? Well, this is any entity, foreign entity, that accepts deposits in the ordinary course of a banking or similar type of business, so depository institutions. An institution that's engaged in the business of holding financial assets for the account of others, so custodial institutions. And then an investment entity. Those are those entities that are engaged primarily in the business of investing or trading in securities, partnership interests, commodities, derivatives, things of that nature. This also includes entities whose income is derived from trading activities, but they contract the administrative functions to a different administrative or to a different investment entity. You can't simply get around this rule by saying, I only hold the assets, I only hold these assets and I have someone else manage them. No, you're going to fall within as a financial institution under the rules. A non-financial foreign entity, therefore, is any foreign entity that isn't an institution. So your most common forms of non-financial foreign entities are going to be your corporations, partnerships, trusts, things of that nature. Now, there are numerous exceptions to non-financial foreign entity. And the most important of those are, for example, publicly traded corporations. So a corporation that's traded on a recognized stock exchange, New York Stock Exchange, Brazilian, any country stock exchange. The other one is what are called active FFEs. So this means that less than 50% of the entity's income is derived from passive source income. So passive source incomes are rents, royalties, dividends, interest. So if you have an operating business, that's going to be an active FFE. Now, FFEs can generally avoid withholding under Fatca if they provide a certification to the payor that they don't have any substantial U.S. owners, or if they do have substantial U.S. owners, they disclose their name, address, and taxpayer ID number. And they use a special form, a Form 8966, to give that to the IRS. So a substantial U.S. owner means that they own at least 10% of the voting stock or value of stock in a corporation, 10% or more of the profits or equity interest in a partnership, and they hold 10% or more of a beneficial interest in a trust. If you have a U.S. person that meets that threshold, they're considered a substantial U.S. owner, and the non-financial foreign entity has to disclose that ownership in order to avoid Fatca withholding and be Fatca compliant. So now we'll move to the definition of a withholdable payment. You have to know what is a withholdable payment to know if you've triggered a Fatca obligation. Well, withholdable payment is a payment of any U.S. source, what we call FDAP income. That stands for fixed, determinable, annual, or periodic income. So the most common examples of this type of income are interest, royalties, rents, dividends, compensation, annuities, and such. Withholding on these payments began as of last year, July 1st, 2014. The second type of withholdable payment are gross proceeds from the sale of property that could produce interest or dividends or royalties. So for example, the most common form of this would be a sale of stock or a sale of a bond. If you sell one of these and they're considered U.S. source income, withholding will apply to those. However, withholding on these types of payments doesn't apply until 2019. So the only thing you have to worry about right now is just interest, dividends, rents, royalties, and that kind of income. So this only applies to U.S. source passive income. So what are the rules on what makes a payment U.S. source? So for example, in the case of interest, if the payor of that interest is a U.S. person, if it's the debt of a U.S. person, that interest is going to be considered U.S. source. This also includes interest that is paid by the foreign branch of a U.S. bank. So if you have the Brazilian branch of Bank of America paying interest, that's considered U.S. source, even though it's being paid by the Brazilian branch. Dividends are U.S. source if they're paid by a U.S. corporation. Compensation is U.S. source if the services that you're paying for are provided in the United States. Rent is U.S. source if the property is located in the United States. And royalties are U.S. source if you're exploiting the intellectual property in the United States. So some common things that are not considered FDAP income for FATCA purposes are capital contributions. So if you have a U.S. investor who's giving you their initial investment to put in, that's not considered U.S. source FDAP income, and that's not subject to FATCA. Another common one that's not subject to FATCA is management fees. If you have a fund here in Brazil or any other foreign jurisdiction, and the management is performed all offshore, nothing's done in the United States, your the fees that you pay for that management aren't considered U.S. source FDAP income, even if they're managing assets in the U.S. As long as those management services are performed outside the U.S., FATCA doesn't apply. Now, there are numerous exemptions and exceptions from the term withholdable payment. Some of these include short-term obligations. These are debt instruments that are paid within 183 days or less. The most common example of these are short-term treasury bills, for example. Effectively connected income. This is income that's generated by an active business in the United States. So if you've got a canning facility in the United States, the income derived from that canning facility isn't FATCA income. And then excluded non-financial payments. So if you're buying goods from the United States, you're leasing property in the United States, you happen to win it big in Vegas, and you hit red on roulette, that's not considered subject to FATCA. And then the other big exception is what we call grandfathered obligations. These are payments under and gross proceeds from the disposition of a grandfathered obligation. A grandfathered obligation is a debt instrument that was issued before July 1st, 2014, and you haven't materially modified the terms. So for example, you haven't changed the interest rate, you haven't changed the maturity date, you haven't changed the payment schedule. Those would all be material modifications. So if you have a debt instrument outstanding as of July 1st, FATCA, doesn't apply to that. So if you determine you are a withholding agent and you do have control of a U.S. source payment, what are your obligations? Well, the first thing you have to do is you have to identify the FATCA status of each recipient. So if you know you're paying it to person A, you have to ask them for a form. You have to ask them for documentation. What is your FATCA status? If you're making a payment to a flow-through entity, let's say a partnership or a grantor trust,